In 2022, investors are facing some of the most uncertainty seen since the 2008 global financial crisis. The US stock market is down almost 25% from its January peak, and the most common question I've been asked is, should I buy stocks now or wait for things to get worse? So in today's video, I'm going to be answering that question with the help of one of the most respected people in the finance world, Jack Bogle. Jack Bogle founded Vanguard in 1974 and is credited with creating the first ever index fund, a revolutionary way for novice investors to access the stock market with confidence. And today I have some clips from past interviews where he gives some clues about how to invest in the current environment. This video is sponsored by SHARESIGHT, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try SHARESIGHT for free or receive 4 months of a yearly subscription. John Clifton Bogle, or more commonly known as Jack Bogle, started his career in finance in 1955 working as an assistant manager at the Wellington Fund. And after a number of jobs in the finance space, he eventually founded the Vanguard Group in 1974. Bogle's theory behind Vanguard was to create financial products that mimicked the performance of stock market indices and charge extremely low fees, rather than trying to outperform the market and then charging really high fees for the fund to be actively managed. This led to the creation of the first ever index fund in 1976, which was called First Index Investment Fund. The fund, which today is called the Vanguard 500 Index, tracks the performance of the S&P 500 Index, a basket of the 500 largest profitable companies in the US. And since over the long run, most actively managed funds will underperform this indice, it's a way for novice investors or everyday investors to essentially invest with confidence broadly into the US market with far lower fees attached to it. Later in 2001, Vanguard would offer the first ETF index fund, ETF standing for Exchange Traded Fund. ETF index funds is probably what you're familiar with if you've heard of index funds before. It's essentially where a consumer is able to buy a single security on the stock market, and simply by buying that through your broker, you're able to access a whole basket of businesses such as VAS, which is an Vanguard Australian Shares Index, and gives you access to the top 300 companies in Australia when it tracks the ASX 300 indice. Before 2001, you couldn't trade Vanguard index funds on the stock market as easily as you can today. What you would do instead is you would deposit and withdraw money directly from Vanguard, and that's still something you can do today, but we also have the ETF option as well. Funnily enough, even though ETF index funds are extremely popular today, Bogle actually believes that for many people, directly depositing with Vanguard or BlackRock, for example, is probably a better approach for a lot of people.
They both own exactly the same portfolio. They're both part of the same portfolio. Their returns will be identical. They both go for around 5 or 6 basis points, and I think now the admiral threshold is maybe $10,000. So if you're down below 10,000, you're probably paying 10 or 12 basis points. If I have a little bias against the ETF, it's because you may say and believe that when trouble comes, you will not get out in the middle of the day. The middle of the day, I mean, come on. It won't be the point of that at all. But as long as you avoid that temptation.
Because then you can sleep that night. That's the reason people get out in the middle of the day.
Oh, wait a minute, though. The market went down 300 points in the middle of the day. You got out, and then went up 300 points at the second half of the day. I mean, a lot of bouncing around. It's meaningless.
But regardless of which type of index fund is best suited for your personal temperament, buying and holding index funds have done extremely well over time.
So he bought 1,000 shares at $15, put in 15,000. And he brought his statement to the meeting.
That's great.
He's held it ever since. And he has paid any taxes out of his own pocket, income taxes. And at the outset, we had a few more capital gains taxes, but not very many. And I don't think we paid a capital gain distribution because we don't sell anything for probably 20 years now, something like that. And I'll ask you, $15,000 in 1976. What does he have today?
Okay. I'm going to say that he has $15,000.
I know you're supposed to be asking the questions.
I'll say he has $106,000.
Well, what a great guess.
I'm way off. Darn it. No, of course I'm way off. I'm not even close. No,
$903,000.
Yes. Yeah.
$903,000.
Yeah. We're going to edit that out.
Now that's all well and good, but does this strategy work in messy, uncertain, volatile economic conditions like the ones we're seeing right now. I spent a lot of time talking about macroeconomic issues in a number of videos previously, especially the last few videos, so I'm not going to go into too much detail in this video. But clearly there are a number of very significant global issues that are plaguing people all around the world. The biggest of them, of course, is inflation. Even just this week, we got new inflation data out of the US, and they reported 8.2% annual inflation as of September, with a 0.4 monthly increase. And even more concerning, core inflation, which excludes the volatile energy and food segments, was up 0.6%. And that really means that even after a number of quite significant interest rate increases and basically 18 months where supply chain issues could have resolved themselves, inflation continues to be a significant issue, meaning more interest rate hikes are likely going to be coming, and that's going to put even more pressure on households and businesses that have debt burdens. And as big of an issue that inflation is, it's still being overshadowed by an even bigger issue, which are the growing geopolitical tensions all around the world and the threat of nuclear war. So given everything that's going on at the moment globally, how can we invest in uncertain markets? Can we use these index fund products, and how should we do it? And while sadly Jack Bogle is no longer with us, he did an interview in 2001 where he explained that not only is a market decline not a bad thing, but it's actually the best thing for you if you have a couple of decades or more of investing in front of you.
The answer is yes, continue to invest. I've told particularly young people in the office who are really petrified by this market decline that it's the best thing that ever happens to him. And if you think about it logically, of course it's wonderful. I mean, think of, say, the young man I was talking to yesterday is probably 25 or 26 years old, and he's got the rest of his life in invest. And I said, well, let's suppose that Chris Scott, his name is. I said, let's suppose, Chris, that the market's going to end up at Jim Glassman's 36,000 by the time you retire. Do you want to be investing all your money when the Dow is at 35,000, or invest it all when it's 9,000? Just think about that for a minute. In other words, you want a long time to invest at low prices, and it's certainly a frightening advantage for those of us who have some money at work in the market today to think of this as a blessing. But it is a blessing because in the long run, investing depends on accumulating money at sound prices and not inflated prices like we have. I also think the general economy and the financial markets are well served by a return to reality. When you leave reality and depart from the laws of gravity, there's nothing but bad things that can happen, and the higher you fly, the more you fall. We flew quite high enough, and I think it's a blessing, maybe a blessing in heavy disguise, a blessing that we've come back a little bit toward the ground.
Most of you watching this video have at least 2, 3, or 4, or maybe even more decades of investing in front of you. That's going to capture the vast majority of anyone aged between 20 years old and 50 years old. Even at that point, you have multiple decades of investing in front of you. And that means that you're going to be a net buyer of shares for many, many years. And if you're going to be a net buyer of anything, whether it's stocks or anything at all, if you're a net buyer of it, you would want to see prices go down. When you go to fill up your car with petrol or gas, do you want to see the price lower or higher than it was previously? Right? If you filled up a few weeks ago at $1.50 per liter and today it's $1, are you upset that you overpaid last time and now it's cheaper? If you paid $1.50 last time and today it's $2, are you happy that you got a good deal last time? No. If you're a net buyer going forward, you want to see the price go down. So what you purchased at last time is kind of irrelevant because you are going to be a net buyer going forward, meaning you want to see the price go down. You need to be buying shares as if you are never going to sell them, that you're just buying them to hold forever. And in a lot of cases, you probably are. You're hoping that you invest either into an index fund or into an individual company that you can hold for many, many years and then just reap the dividends that come from that investment. Maybe you do have to sell it at some point in the future, but ideally you won't have to. And this applies to individual stocks and index funds. With individual stocks, it is a little bit trickier, right? Because you need to be assessing specifically what you think you can get out of that business in the future and making sure you're paying an appropriate price. Whereas when it comes to an index fund, you're broadly making a bet on the US economy going up over time rather than assessing the cash flows of the economy or the top 500 businesses, for example. But in both cases, you are certainly happier to see that prices are cheaper today than they were yesterday, that the market is offering you a better deal today with the money that's coming in from your income today than yesterday. And if you're wondering why this video may sound familiar, it's because I said the exact same thing on March 26th, 2020. If you are willing to put money into the market and forego it for the next 10 years, you don't need access to it, then it makes absolutely no sense to be waiting out of the market. If you're index fund investing, which is what most people should probably be doing, 99% of people, you will be buying an index that broadly invests your money into the top businesses in the US market or maybe the Australian market if you're in Australia, and you just simply need a dollar cost average plan. This was 6 days after the market had bottomed in 2020, and since then, even despite the significant decline this year, the market is still up over 60% since then. Oh, and here's some fun comments from that video that aged like milk. So go on, leave your comment about how things are gonna get worse, and then in a few years, I'll look back at these comments and I can laugh at you too. Now, did I have a crystal ball that I was able to shake and see, okay, the market had just bottomed? No, of course not. And in fact, even when I was buying at that time, the market could have continued to go down for some time in the short term, but that is completely irrelevant because when I'm buying, I'm making a bet, at least in index funds, let's say, I'm making a bet that over the very long term, businesses in the US on average will be more productive, the economy will be stronger, and therefore index funds, which are a basket of the biggest companies, will be more profitable and have higher prices. So this time around in 2022, next year, the year after that, could stock prices continue to fall in the short term? Absolutely. And there's really no way that any of us can predict what is going to happen. I find it fun to listen to theories about what might happen from Michael Burry and Ray Dalio and these kind of guys, but I never consider that in my actual investment process. And the reason why is it doesn't matter. I'm buying stocks to hold for the long term, for my retirement, to build my wealth over time. It doesn't matter what the market's going to do in the next 1 or 2 years. I'm not going to be selling the index funds I'm buying today for 2, 3, maybe even more decades. And over that period, it's extremely likely that they will be much higher than they are today. So what's the best approach for actually buying these index funds? Like, how do you actually go about it? Well, there's quite a few variations, I think, in slight variations in how you actually go about buying, whether you do lump sum or you spread it out evenly over time. And there are slight differences in returns for those different methods, or there's different studies that have shown different returns for those methods. But what everyone can agree on is that timing the market is the worst strategy. If you catch yourself thinking, oh, maybe I'll just wait to see if things get worse, or let's just wait to see when things improve, that's your brain acting on emotion. That's your brain trying to piece together how you feel about the fact that your portfolio is down. You need to stop that immediately, and the best way to get out of using emotions when it comes to the market is to do what's called dollar cost averaging. So what I do is I take a set percentage of my income every month and I invest it into a basket of index funds. And that essentially means that the amount that I'm investing is predetermined, and when I'm investing, the specific intervals throughout the year is also predetermined. So regardless what is happening, I am making those investments. It takes the emotion completely out of it. Hope you guys got some value out of this video. As always, if you did, I'd very much appreciate it if you could hit that subscribe button. We're getting super close to 100,000 subscribers, and I can't wait to hit the milestone. So if you want to be a part of the first 100,000 subscribers on this channel, then hit that subscribe button. But with that said, hope you guys have a great day. I'll see you in the next one.